Hello everyone. Good evening. Welcome to today's session on fundraising, when and how much to raise, in partnership with Vizag Industrial Scan and Qapita. Fundraising has always been the topic of interest for the startups. But you know, the previously whenever we had sessions, everything was covered in terms of what are the milestones at which you need to look for funding and how much and all. But the other aspect of at what valuation, how much should you dilute at each stage, and what are the implications of those dilutions? And most of the early stages is startups ignore the aspect of giving sweat equity to retain your early talent and managing the cap table. And then about creating the ESOP pool. So today we have Srikanth and Vikram to take us through these aspects of fundraising. So over to you, Vikram and Srikanth.
Sure. Thanks a lot, Anudeep. Let me just present my screen. Yeah, is my screen visible?
Yes, you can go into the slideshow. Yeah.
Perfect. Great. Thanks a lot for all for taking out the time. So we are Qapita. I'll just give a brief introduction about the speakers today. So I'm Vikram. I'm country head for India at Qapita. I'm a chartered accountant by qualification, also passed out of IIM Ahmedabad in 2008. And I have spent most of my life as an investment banker. Started off with Citigroup IB in Mumbai, but spent almost 9 years after that with a boutique firm called Spark Capital, based out of Bangalore, Chennai, and Mumbai. Around 2 years back, I wanted to go where the action was hottest. So I wanted to be part of a startup. So I joined a former client of mine, a rural e-commerce startup, worked there as a CFO for a year and a half. And it's been close to 5 months for me now at Qapita. Srikanth, you just want to introduce yourself?
Yeah, hi everyone. Thanks Vikram and thanks Anudeep for this opportunity and introducing us. I'm Srikanth. I'm also part of Qapita. We are a recent startup into the fray, and I joined the startup recently as well in January. Last 5 years, I was with an early stage incubator, and perhaps I'll be able to relate with a lot of you. I see there are a lot of early stage startups here. So I was in an incubator working with very early stage startups in their incubation and investment journey, and that's how I kind of got myself into the startup ecosystem. Qualification wise, again, have a finance background. I have been in the investment banking space for about overall 10 years with stints in Goldman Sachs and Royal Bank of Scotland, and being an engineer and an MBA, like many of us here. So that's a quick introduction, and look forward to interacting with you. And we can also use the chat option for the question and answers while Vikram is beginning with the presentation, and we'll try to address those questions both in the chat as well as through the towards the end or towards the middle of the session. Over to you, Vikram.
Perfect. Thanks, Srikanth. So the one thing which Srikanth and I have in common, apart from being part of Qapita, is throughout our careers, we have worked with a lot of entrepreneurs. We have been inspired by them. And the excitement we felt at in our current role is also an opportunity to work with more people and help solve their problems. Hopefully this session gives people that attendees here a sense of how and when to raise capital, what does dilution mean, and how does the process itself work. But we'll be happy to engage even post this session. We'll share our contacts with Anudeep and would love to sort of engage even in a different sort of context. So what we seek to cover in this session, like Anudeep sort of put out, is to give a flavor of this whole fundraise process itself. So I will tailor this more towards early stage startups, which I'm sure most of you are, who are looking to raise funding. And both from a let's say fundraise perspective, that would let's say be the first part of our presentation, and a short session after that on how you reward your early employees through ESOPs and how that process sort of works. So that's pretty much going to be the agenda for the day. Let me just start by presenting a view from an entrepreneur's, from a founder's perspective. So you have quit your job, you have this phenomenal idea, you want to put the next 5-10 years of your life behind it, and you come to the question of capital, right? So how do I raise funding, and what are the sources of funding available for me as I go out and as I sort of work on this idea and as I sort of start my company. Just to give people a perspective, so there's just a broad view of what are the choices available to you as a founder. You will typically start off with internal sources of funding, self-fund the company with your savings, or ask your friends, family to sort of invest in you. That's how typically most companies sort of start off. One thing which is happening with startups, and where even startups are seeing this focus on sustainability and profitability. Beyond a point of time, one way in which you can sort of power your growth is by the business itself generating enough profits, generating enough cash to sort of meet your growth plans. So that's let's say internal sources of funding. Apart from that, external sources of funding, you have debt. Again, it's something which for the most part maybe out of reach of a lot of startups, of a lot of early stage companies. But there are a few nuances which I want to put out here as well. So you can have short-term debt or trade credit. So trade credit, depending on the nature of your business, is often a very ignored sort of form of funding. You will discover that the way you sort of structure your business model and the way you run your business, your suppliers, your vendors can actually provide you the capital for your initial phase of growth and expansion, right? So I used to work for a company which had a negative working capital cycle, which means we got paid in advance, and we had a bit of time to sort of pay our vendors and suppliers. So that float in the system itself allowed the company to sort of grow with very minimal capital for a period of time. So this again is not a permanent solution. It is something which you can explore, especially in your initial sort of phases, where you can sort of see if you can get if you're solving a very important problem for your customers, you can ask them payment in advance. If you have some good terms with your suppliers, you can sort of take a credit period from them, and that can help you drive your business. Long-term sources of debt again are sort of possible. Again, the traditional thinking from a debt provider's perspective is that you should be a cash generative business, profitable, etc., which most startup at an early stage may not be. But it is still possible to explore sources here. And there is a new class of unsecured structured debt which is coming up, venture debt and structured debt, which specialize in providing debt solutions for startups and early stage companies. And they have different ways in which they sort of seek to look at you as a credit risk and extend finance to you and look at repayment as well. But effectively, any source of debt you take up will have to come up with the obligation of repayment. So that is something which will weigh on you as a startup and on you as a founder as time goes by. Which is where we come to the focus of today's discussion. External equity, right? Whom can you raise equity capital from and equity funding from? You have angel investors, high net worth individuals. Typically, the first port of call for many entrepreneurs, for many founders, is to go to these angel and HNI sort of investors. You have family offices, which are a little bit of an aggregation of these sort of investors, but potentially take up, you provide funding and take up stakes in early stage companies as well. As you sort of mature and sort of evolve as a company, you go into what is called as institutional funding, venture capital, VC and private, and PE, private equity. So your venture capital sort of investors typically, may write between a $1 million and a $10 million sort of check for you. Typically come in at an early stage of the company when maybe when proof of concept is established, but when scale is not as much established, profitability is definitely not there. They take a fairly big risk, and their return expectations are also very, very high, considering the stage at which they sort of invest in you. As you mature, and for certain types of sectors, you go into the territory of private equity. So PE is again a larger ticket size, an institutional investor who typically writes anywhere from 5 million to 25 million, 50 million, and even beyond. But they will look for a certain type of companies which have demonstrated some reasonable scale, no issues from a product market fit or from a proof of concept perspective. Company should be well beyond that scale, where their capital primarily goes towards the growth. So it's a proven business model. All it requires is capital to sort of make the business model grow by 3x or 5x over the next 3 to 5 years, right? So that's a typical sort of profile which private equity investors sort of look out for, which is why they enter at a later stage in the life cycle of the company. So the one thing to note here as a founder is that all of these things come with a cost, right? They say equity is typically the most expensive form of funding. And that's because the thing to note from an entrepreneur's and from a founder's perspective is that equity, eventually, when you take external equity, there has to be an exit provided. Unlike debt, where you have to pay out the guy in cash or pay out the provider in cash, you don't need to pay out or buy out your investor in cash. But you need to provide some sort of an exit, which either means scaling up large enough to go for an IPO, get yourself listed, or find a suitable buyer to acquire your company and provide an exit to the investor, or find another larger investor to take out your early stage investor at some point of time. So this is something, it's not, I would say this is not like free capital. It comes with certain obligations, and it's important that founders understand, as they sort of go out and raise, and also understand the pitfalls of, dilution, giving up a lot of stake to external equity providers at an early stage of the business. So how do external equity providers, investors, how will they view a business? How will they evaluate a business? What really goes into what they consider an investable company? So if I were to bucket this, I will put it into, let's say, 4 buckets. The business itself, your industry which you're operating in, the business model which you're going to showcase to the investor, and if you have somewhat of an operating track record, you already started the business, you have some proof of concept already established, you're able to showcase some metrics to the investor, all of it goes into his decision making on whether he wants to invest in you or not. The other most critical portion of it, especially for early stage companies, are the profile of the founders and the team. Who are the founders? What is their background? What experience do they bring to the table? And what is most important, again, is skin in the game, right? So the one thing which I'm going to cover later is one of the pitfalls of diluting too much equity early on. Means that at a later stage, you may actually, as a founder, get diluted to a fairly sort of small number, a small stake in your own company, which makes your future rounds of funding difficult because investors will question your skin in the game. To actually say, okay, this company is 75% held by investors, the founders only hold 20% or 25%. Will they even be motivated to run the company if I invest, right? So those questions keep coming in. So what are the founders' skin in the game is something which investors sort of look for. And when you deal with professional investors, everybody wants a return on their capital. They want to take their capital out. So exit prospects. What is the investor's perception on, okay, I'm investing in this company. How likely do I see this company scaling up with this capital or with future rounds of capital going in for an IPO? How valuable will this company be, which we are together building? How valuable will this company be to a potential acquirer? And can I sort of influence the founders to sell the company and give me an exit? Or if it's a sector which is attracting a lot of interest from later stage investors, then potentially can I give my stake and can I sell my stake to an investor at a later stage? I come in as an angel round or a seed round investor. I sell to a Series B or a Series C investor and make my exit, right? What is the likelihood of all of these things happening? These are things which investors will look in as they sort of evaluate a company. And the final thing, which again, a lot of founders don't really focus a lot, but we're just highlighting here, is as part of the investment process, you will go through this process of due diligence, where the investor will go through and substantiate a lot of the claims which you made when you sort of took the company and presented the company to the investors. Apart from that, if you have an operating track record, what is your track record of compliance, governance? Because all of these things at some level impact the value of the company itself and the value of the investment which the investor has in the company. So that's another sort of component in how the investor views it. So moving to what does equity actually mean? So one perspective which we want to give out here, from a founder's perspective, when he looks at equity and the term, it's an element of economic ownership, right? So if I hold, let's say, 75% stake or 80% stake in a company, then I actually am entitled to 75-80% of the value of the company or the profits and the cash flows which the company actually generates. So that's economic ownership. Another element to look at it is in terms of control. So your Companies Act in India today talks about certain thresholds for control. So if you own more than 51% stake in a company, you are set to control the company, right? If you hold more than 76% stake, that carries with it certain rights. If you hold 26% and above, that gives you certain, sort of minority rights as well. So equity is also an element of voting control in the company itself. But the way we sort of look at equity is a value which the investor puts onto the investability quotient of your company. So with all the factors which I laid out in the previous slide, the investor studies all of that and makes an assessment of what is the rupee value or a dollar value which I can put to the company the way it stands today. That eventually becomes your valuation, right? And that becomes your valuation, especially in cases where you don't have an operating track record. Founders should look at equity as as a currency. So you will part with equity as you scale your company. What do you part with equity for? You will part with equity for capital. to grow the company. This is obviously the most talked about thing, which we, as founders you will sort of read about it and talk about it. You will give part of your equity to financial investors in exchange for capital and funding to grow your company. You will part with equity for talent to attract the right set of employees who will help you build the company and take it to the next level. And another use of equity is also to foster some strategic relationships. You may find a larger player, you may want to give a certain stake or allow him to invest in your company, because he may have a key role to play in the growth of the company and in the sustainability of the company. So this can either be from strategic investors, or you can actually get strategic relationships from some of your financial investors as well. So equity is the most valuable currency, and pretty much at an early stage of the company, the only currency which the founder has. So yes, as founders, you have to be very, very careful in the manner in which you part with equity. Which is what brings us to like I said, the investability quotient. What is a value which the investor puts onto your company when you go and present it to him? Therefore, how much capital can you raise and what dilution will it result in your stake? These are all things which, as founders, you should be very, very sort of concerned about. Apart from the absolute number, to say that, okay, I'm bringing in an investor, he's investing, let's say, $1 million for 20% stake. That is something which goes beyond that, which falls into investor rights. So apart from your valuation and the stake, it's also very critical for founders to understand what rights you're giving the investor, because that has a role on the stake as well. So you may have an investor who may offer a very high valuation, but he may have other clauses to say that he's entitled to take out a multiple of his capital in the event of an exit. So in return for higher valuation, he's putting a very high threshold on you to sort of create an exit for him. So it's important to understand some of those rights as well as you go down the fundraise process. Coming to timing, what is the right time to sort of raise funding? I just want to give this concept of when is something, when you present it to investors, when is it an idea and when does it become a business, right? So in terms of timing, yeah, I think it's very easy for someone to say the earlier the better sort of a thing. But the timing at which you take your business proposal, your investment proposal, and present it to investors, that has a role to play on the valuation and the dilution as well. So if you go to an investor, let's say typically angel investors at a very early stage, let's say you have a great business idea, you have a plan, you may have even built a team, but you don't have a running business. You will necessarily have to dilute more. So for whatever the investor is investing, he will perceive a certain risk to say that the idea is good, but I don't see a running business yet. So I don't know how this idea will translate into execution in the market. Therefore, I perceive a high risk, and therefore I will ask for a higher stake in the company, which means a lower valuation. That versus potentially approaching the investor at a later point of time. Let's say if you're able to do it to start the business, bootstrap it yourself, or rely on internal sources or even debt sources to start the business off, and go to the investor with a running business, right? So the stage at which you approach the investor has a bearing on the valuation and the dilution itself. So if I go and I've already demonstrated proof of concept to the investor, that reduces his risk perception, and that will actually result in him placing a greater value on the business at this point of time. So he may sort of offer you either higher capital for the same sort of dilution, or it will be a lesser dilution in case you're keeping the capital constant, right? So it's always going to be a trade-off for founders as to when do I go out and approach investors and start raising capital. So I would say my thumb rule is, to the extent you can bootstrap it yourself, and the more you can prove that you have made progress in this business by yourself without capital, that is something which the founder should do. And only when the founder gets into a roadblock to say, without capital, now this business will not scale, that is when you should actually go to the investor. There you will, you can put your hand to heart and say that, without capital, this business won't scale. I've done the maximum which I can. So what valuation I get is the best valuation which you can potentially get. At least that's something which you can sort of convince yourself on, right? So this is what I'm talking about to say, there may always be pressure to raise faster, which may result in more dilution. But if you're able to wait, demonstrate the right metrics to investors, you can potentially raise more, maybe at a lesser dilution as well. So this is unfortunately not something which is completely in the hands of the founder. You will be motivated and influenced by external factors here as well, depending on the sector, the competition. So if you are starting a business idea and there are other competitors in the field, If they are raising capital and they are deploying that capital, potentially you might lose market share, and you might lose, your business may not be as valuable. So there's a little bit of a race to be first in the market to sort of grab market share as well, and that is something you need to balance. And the business model itself, if it's a business model, let's say for example software, right, where potentially you can take your time, you can build a product and you can go out and meet investors, that's actually good. But if you're in a B2C sort of a facing business where you need to actually acquire customers and showcase traction and show market share, you may not have a choice. You may actually have to go out and raise capital faster. So a bunch of factors affect your timing of fundraise. But as a thumb rule, the more you can demonstrate to an investor before you go to him, the better it is from a negotiation perspective for your stake and for your dilution. Coming to the quantum of funding, again, very easy for me as a banker. I always had an incentive to say, as much as an investor can offer, please go ahead and please take it. But now that I'm on the other side of the table, there are some nuances here as well. So if you ask me the thumb rule with respect to quantum of funding, every founder should raise as much, right, to either take him to the next round of funding, right, which should give him with enough margin of safety, complete confidence that yes, I can execute my growth plans and I can create something with the funding I'm taking from this investor, which will be valued by the next set of investors. So at a seed stage, the confidence you have to say that, okay, if I raise this $1 million at seed stage and I execute for 2 years, I'm very confident of a $10 million Series A fundraise, right? This is especially very important if you are running a business which may be loss making, where capital is actually required for the sustainability and in sort of a survival of your business. The other way to look about it, which again is an option depending on the industry, let's say for example SaaS companies, software companies, is that you raise a certain amount of capital and you push for sustainability, push for profitability, get it to a point where you are not dependent on external capital for growth. If you're able to achieve that holy grail, then that puts you in a very, very good position in front of investors as well. You have a lot of negotiating power. You are not beholden to the next set of investors to, for the survival of your business. And that frees you up to actually go out and, have a negotiated conversation with the next set of investors to say, I don't need your capital for survival. I need your capital for growth.
Vikram, small interruption. Can you just hide that pop-up of stop sharing?
Yeah, let me just do that. It's better now?
Yes.
Perfect. Sure. So again, what are the determinants as you sort of think through on the quantum of funding? How much runway do you want to keep? Like I said, your as a founder, your focus should be take this amount of capital, showcase to an investor what you're able to achieve with this amount of capital, what you're able to execute with this amount of capital, which means that you may have a certain runway, right? And what is a runway which you feel is comfortable for you? 18 months, 24 months, maybe even beyond. What are your growth plans? How quickly will your business consume capital? That's again, something which plays into your quantum of funding. What sort of a safety margin? How volatile is your business? Is the industry? We have all been through COVID, so the concept of safety margin now, becomes very, very critical. And the most important thing is how do you see your entrepreneurial journey panning out when it comes to fundraise? So you are going to raise, let's say, a seed round of funding, and let's say you're comfortable diluting 20% stake. Where do you see this business going? Do you see yourself doing Series A, Series B, Series C? If so, then you should, as a founder, you should have some sense that this is how much I want to dilute in each of these rounds. Because ultimately, when you come to a point where you become self-sustaining, where you become profitable, or when you go for an exit, what stake as a founder will you be left with in the company is something to sort of think about as you think about the quantum of funding. This is where I think a few founders probably get it wrong. They dilute too much too early. Either because they don't negotiate the rounds well with the investors, or they don't demonstrate enough to the investors to ask for a higher valuation and limit their dilution. So what ends up happening is by the time they get to Series B or Series C, they are diluted down to maybe 20%, 25% sort of a thing. And the next round investor basically looks at it as a concern to say, I'm not sure what skin in the game the founder has. So if you are in a business model which is going to sort of involve multiple rounds of fundraise, how do you see dilution across each of those rounds of funding? And this I've seen as a negotiating point even with your current investors. I've seen entrepreneurs and founders go to investors and say, I cannot give you a lower valuation because I'm going to raise capital in the future. And it will hurt all of us if I am diluted below a certain point. So for that reason, you actually have to give me a reasonable valuation. So people have actually taken that as a negotiating sort of tack as well. So just to cover, what will you go through as a founder when you embark on a fundraise process? So there are a few stages here. Some of you may already be familiar with it. Some of you may already be somewhere in any of these stages. But for people who are evaluating it and thinking about it fresh, what you have to do first as a founder is make your investor pitch, right? So that is a session by itself. I'm not going to get too much into the details of that. But what do you feel you have to highlight to investors to convince them to invest in your business, right? Your industry, a lot of the factors which I covered in the first slide are things which you ideally should have in your investor pitch. So typically this takes a form of a PPT presentation. Along with this presentation, it's important for founders also to prepare a financial model or / a business plan. You may be sitting at an early stage. It may be very difficult to sort of sit today and think as to what this business can accomplish in 3 years or 5 years. But it's important to, one, present a vision to investors to say that this is where I want to drive this company. And if you are giving me this capital, then this is what I'm starting with as a base plan. The plan may change depending on how the situation evolves. But at least where I'm sitting today, you are demonstrating to an investor that you have thought this through. And you have some logic to say what you're saying. Otherwise, if I go and say that, I'm going to create a unicorn in 3 years or 4 years, and my company is going to have revenues of some $500 million, uh, are there any, is there any logic or are there any assumptions which have gone into that number itself? Is something the investor will test you on, right? If they discover that, it's more of a benchmark rule of thumb sort of a number, not something which the entrepreneur and the founder has thought through, that is going to be a little bit of a dampener for the investor as he considers your investment. So not to say that you are able to sit today and predict the future with complete certainty, but at least you have a plan and you have thought it through. And as you prepare this business plan and projections, you may have or you may sort of discover new things yourself. You may find out that certain things may not be possible with the capital you're planning to raise. You may find that you are actually underballing with respect to certain aspects of a business, and you can actually grow even faster, or you may discover new ways to grow faster even with minimal capital. So going through this process of preparing your business plan, having numbers behind it in terms of how much revenue, how much cost, profits, and how much return on capital can you eventually generate, that's an important process. That's something which founders sort of have to go through. Once you have your collateral ready, you have your presentation, your pitch ready, you have to target a set of investors. At an early stage, typically it'll be angel seed stage sort of investors, and it's always critical for founders to research and figure out the person who's on the other side of the table. What sort of a person is he? Has he invested in certain sectors based on the angel's background or the investor's background? Do they have a preference for certain sectors? Do they have experience working in certain sectors? What is their appetite? How much of a check size do they typically write? Is it like going to be $500,000, $1 million? And what is the interest level as you sort of go and speak to investors? This should give you a sense as to how likely is that investor to bite. Right? One, even as you sort of prioritize your investors, you get a sense of whom to go after first. Whom do you think your pitch will resonate with better, and target those investors first. And also, make a judgment after the meeting to figure out, okay, is this a person who will sort of put up their hand for investment, or is he just going to drag it on and take a lot of time? So that's something critical for you. Yes, the typical process, you will have to have multiple conversations with a bunch of angels, with a bunch of institutions before you convert one. But the hardest part is finding one investor to sort of back you. Typically, once you get one investor to at least write a part of the round, you'll always be able to convince others to sort of tag on to him and sort of complete your round. At an early stage, it's very, very critical for founders to look for value beyond just the funding and beyond the capital which the investor is sort of putting in. Because at an early stage, and especially with angels, their value and what they also advertise to you is that we can open doors for you. We can give you value beyond capital. We can help you think through about the business. We can connect you with the right people, the right suppliers, the right investors, maybe even the right co-founder. So these are all things which angels typically do for their portfolio companies. So you should also look for people whom you believe can add value in your business, depending on your business, depending on where you sort of see shortcomings in your plan itself. But yeah, definitely leverage your investors to grow the business, and it's up to the founders to push them to sort of get more than the money out of them. Once you have a set of investors who have agreed and who see enough interest in you, This interest will take the form of typically a written document called a term sheet, where the investors get together. They just list out all the terms in which they're investing in you, including your valuation, how much capital they're investing, what is the dilution going to be. All of that gets captured in a term sheet. So what is very critical for founders to understand is that when you get a term sheet, and that's a standard investment practice, not just here, across the world, this is a non-binding document. So there is no obligation on either party, or either the investor to consummate the investment, to actually go out and give you that check, or for you as a founder to even take that sort of capital. You can always find a better offer and you can sort of move away. The term sheet is just to sort of clarify the intent of both parties, save time in future negotiation, and at some level try to create a framework which you don't sort of revisit at a later point of time. So it is unfortunate but fairly common to see term sheets being abandoned, to see investors walking away from term sheets. And at least in my experience, I've seen a lot of founders go through a lot of angst. They may have made some plans, they may have made some promises. In some cases, they may have even started their expansion plans on the expectation that capital will come in as soon as they sort of see a term sheet. So that's I would say, a very common fallacy. The journey doesn't really, the process doesn't stop at a term sheet. It's just the start of the process. It's a very significant achievement, but you still have to keep at it till you get to the point where the cash actually is in your bank account, right? So yeah, so you may, if you're in a good position, you may have multiple term sheets from multiple sets of investors, where you may have the luxury of choosing among them. Where it becomes critical to see, yes, obviously an investor is offering the best valuation, who's offering the maximum capital for minimum dilution, should be preferred. But like I said before, having a look at the investor rights is also very critical, because the rights may have a bearing on your stake and on the dilution as well, beyond what is mentioned in the term sheet. So once you execute a term sheet with a set of investors, we come into what I sort of alluded earlier, called due diligence, the process called due diligence. So this is where basically you would have made a lot of statements in marketing your company, in talking about the industry, the business model, etc. The investor typically, when he gives a term sheet, takes it at face value, and you will actually see the disclaimer in the term sheet. It's non-binding because they will say we will subject to satisfactory completion of due diligence. So effectively, the investor is saying that, yeah, I take you at face value, but now I'm going to sit and I'm going to study a lot of what you've given me, and I'm going to try to benchmark it and validate it in the market. So due diligence can take multiple forms. Business due diligence is the most sort of common form for early stage companies where you may not have a running business, where the investors will actually go by themselves, go into the market, try to figure out if what you're sort of saying resonates with what they sort of see in the market. It may involve some customer testimonials, some market studies, customer satisfaction surveys, etc., for them to make up their mind that, yes, we are looking at something valuable here. If you've already started the business, you have a running business, you will have a couple of additional obligations in the form of financial and legal diligence. So financial diligence is where either the investor or maybe an external agency, an accounting firm, comes in, reviews all your financials, your financial records for the past 2 to 3 years, and tries to correlate it with what you're sort of saying from a future perspective, right? So it's again a validation of have you actually delivered X amount in terms of revenue, in terms of profitability, in terms of return on capital so far. Another process also happens called legal due diligence, which is typically done by a law firm, is where they come in, they take a look at the legal framework in which the company is operating. All your contracts, are there any litigations against the company? Are your corporate secretarial records in order? Have you conducted board meetings? Have you done all the necessary filings? Have you complied with the regulations in each of the areas where you're operating? And in case they find any discrepancies here, they will highlight it as a potential problem for the investor to resolve, right? So this is basically for the investor, before his capital goes into the company, to be aware of anything and everything from the company's perspective, so that he walks into this investment with his eyes fully open. That's the intent behind going through a due diligence process. So in early stage companies, due diligence could be like a very simple thing. In many cases, investors do a lot of the business due diligence even before they give a term sheet. But especially for slightly later stage companies, this is a process which could take from 1 month to 2 months to 3 months, which will happen post term sheet, and which may result in certain obligations for you to say that I have noticed certain irregularities in compliances, in your filings, in your contracts, or even in your business practices. I would want you to fix all these things before my funding comes. So that's the, let's say, the fallout of some of the things which may come out, the findings which may come out from due diligence. So once your diligence is complete, the investor will use a set of law firms and he will create what is called as definitive documentation, which will take the form of a shareholder agreement, which will set out the rights between the investors, the founders, and the other shareholders, and a share subscription agreement, basically to say that, yeah, I'm giving you X amount of money for in return for a certain quantum of shares. This is when the process actually becomes binding. So once the SHA and the SSA get signed by the investor and by the founders, that is when there's a legal obligation created for the investor to invest capital in the company. Until that point of time, the entire process is non-binding. Investor can choose to walk out at any point of time, right? So your documentation process typically, I won't go too deep into it because you will have a legal counsel. Typically, you will hire a legal counsel to represent you, to review the documents and to sort of negotiate them with the legal counsel of the investors. Once all of this is done, you get to the point where you actually get the funding. But there may be, like I said, a few conditions which you need to satisfy, a few of your non-compliances, etc. The investor might say, okay, I'll sign the documents, but I will invest in you subject to you fixing all these problems. So they will take on a legal form called as conditions precedent, and that will be a part of your document itself to say that, I have noticed some 5 things which are an issue from a company perspective, which give me some worry as an investor. So I want the founder to fix those 5 things. The moment he fixes those 5 things, I have an obligation to pay you the money to complete the funding. So this is, broadly how the process of funding, sort of takes. If you're lucky, this process can be done in 2 to 3 months. But in some cases, it may take time. I've seen it take 6 to 9 months, maybe even a year, right? A lot of what time will actually be spent in the first, 2 stages of the process. Once you find an investor, assuming that your books are financial records, and your compliances are in place, stage 4 to stage 6 should be a little bit of a process. Can all be completed in maximum of a month and a half. But yeah, provided you have the right set of investors who are interested in your company and with an intent to sort of see it. So I'll pause here and I will turn it over to Shrikant, so that he can cover the. Yeah, let me stop sharing.
Okay, great. Thanks, Vikram, and everyone. Feel free to use the chat option to paste your Q&A. So maybe what we'll do now is Vikram covered all aspects with regard to fundraising and the process of fundraising. We'll try to get a more visual representation, because what Vikram showed was more a lot the holistic process. But maybe we'll take an example of a startup and maybe something that you might all relate to, and then actually run some of these scenarios. What is fundraising, what is dilution, how do you look at cap tables, right? What is cap table? So it's a shareholding table, right? So we'll actually look at that more from a practical element, and we have our platform which enables you to do that. So I'll quickly share our platform for that. And yeah, if there are any questions in between as well, we can address them. So I hope you're able to see my screen. Yeah. So yeah, so we'll try to cover some of the aspects that Vikram covered in the presentation, more from how does that all come down to ownership. As Vikram mentioned, that equity is actually the precious asset, precious most asset actually, which everyone is going after, right? And there might be many of you, and even looking at some of your startup names, I realize some of you might not have raised funds till now, right? And you might be sitting in that in the fence, whether should I raise funds or should I not, right? And again, like Vikram alluded to, all the different parameters or determinants, why you should go or why you should not, right? And in some cases, maybe you're fine without raising funds, because maybe you are a cash surplus business, you're growing at a healthy rate, you're a local business in your geographies, let's say, right? And maybe you don't need that boost of equity funding to blitz scale in some sense. And that's a word that people use, that just pump in a lot of money and scale exponentially. But you are fine with the kind of growth you are doing, and that's perfectly fine as well, right? And that's where the points that Vikram mentioned is only if you want to grow at a particular benchmark that the market is growing or other competitors are growing, whether you believe that capital can really unlock a lot of value for the shareholders as well as solve the problem you're setting out to solve much earlier than then you could do with the growing linearly or growing in a bootstrapped way. And finally, there are some businesses which need that upfront capital, right? And that is what we will kind of take some of the examples here, right? So I've just logged in, and this is a very it's a fictitious company. This is just a simple company, as you see. You might relate, a lot of you might relate to such a company. It just has 4 stakeholders. It has about uh, total cash it has been infused is about 90 lakhs, which is 9 million, right? Now this is a any other company, let's say, where the promoters themselves have pumped their money, right? And others have not been issued any shares. There are about 12 lakh shares issued in the company. If you look at this company, there is equity and there is equity awards. This is ESOPs. Vikram will cover this very briefly. And then you can also see all the stakeholders. I have on purpose renamed all the stakeholders as fictitious, like promoter 1, promoter 2. So this is a quick summary of, let's say, the company we want to discuss today. Okay, and now let's go into the cap table, the actual cap table. A lot of you might have created or seen your own cap tables. A cap table is nothing but a shareholding table, right? So you have the name of shareholders here, you have their number of shares and their percentage, right? uh, so as you can see, the two promoters company here, so they roughly own about 67% of the company. And then there are some, typically you might have been incubated somewhere, right? So they would have taken some small amount of equity from your company, right? And then there might be an angel investor who's put in some money, given you have given some 8% to. And we'll come to all of this, why you have given 8%, and or we'll rather look at what are the future options available to this company in the context what Vikram just told you, right? And then you see that we have also created some ESOPs, and we'll cover ESOPs very soon, and I'll also bring demo it in more detail. But this is basically a portion of your company that you actually saw here in the dashboard. You saw that about 25% of your company you have not given out to any shareholders yet. You have carved it out as a pool, and you are basically want to give it to your employees. So in fact, here you see you are already actually allocated 19% of that 25% to employees, and remaining 6% is out there to be allocated, right? And we'll come back to this a little later. But right now let's focus on, okay, this is your shareholding, right? So about 67% lies with the promoters, about 8% is given to angel investors, and a minuscule amount given to an incubator. Maybe because they have given you a space, maybe they have given you a mentor, or various other reasons, right? Now let's assume that this company, now this could be your company, if you think about it, right? Now it has not raised money. In fact, if you see, this angel investor has also invested money at a face value. What is a face value? Face value is the value at the par value of the shares, basically, right? And many a times shares are issued at a premium when you're giving it to an investor, but at a face value means at the par value at which the shares are valued on the books. And the remaining is called premium, basically. We'll get into those details later. So this investor has actually put money in about 9 lakhs, but if you see that the maximum amount is actually invested by the promoters themselves. So it's a very bootstrapped company. Like I said, many of you might relate to it. Now let's assume this company is going to raise money, right? So now what does this platform help you do? And this platform is available to all of you as well. You all can set up your cap tables on this platform. uh, you can actually choose to run some scenarios. Okay, so let me actually run to explain the concept of dilution. Let me actually run certain scenarios which might be of relevance to you. So let's run a finance round scenario. A finance round basically says that assuming your you have about 12 lakhs was your valuation, because all the shares are valued at 10 rupees, let's say. And your your option pool, so and so, all the details are summarized here. Now let's assume that this company raises a seed round, because it has already raised a angel round from some investors. So next logical step for it to be is to raise a seed round. Now what could be a typical seed round? So you see that this company has already, if I go to the cap table again, so sorry for the back and forth. but if I go to the cap table, it's already raised some 90 lakhs through its own bootstrapped of the promoters. But let's assume this company now raises a seed round of, let's say, 2 crores, right? That's a realistic thing because the promoters have put in 90 lakhs. They've brought the company to a level, and now they want to go further in the scale. So let's assume we do a seed scenario. So I'm just naming a scenario here. So let's say it's a 2 crore scenario. So let's call it a seed round as a round name. And let's say now the concept of pre-money valuation. But before that, let us freeze the investment as 2 crores, right? So I'm freezing, it's 20 million, it is 2 crores. Okay. Now what could be the, let's say, the pre-money valuation? Okay. So like Vikram mentioned, every time an investor puts in some money, right? The investor wants to take some share of the company. Now, this is where the concept of dilution comes basically. So for giving out 2 crore worth investment, for bringing in 2 crore worth investment, you have to give away some portion of your company. Again, take if there are any indications, if anyone wants to have any particular number, we can try that. But maybe as the first case, let's assume this company is valued at 8 crores. Okay. Now, when I say somebody is putting in 2 crore and you're already valuing the company at 8 crore, the post-money valuation in this case will be the pre-money valuation plus the investment. So that becomes 10 crores, right? So anyone wants to answer now, if somebody is putting in 2 crore worth investment into a company which is worth 10 crore post-money, right? So what is the stake that the investor is making? Any quick guesses? Or it's not really a guess, but it's more a calculation. Anyone wants to type in the chat? Okay, so 10 crore is the post money, as Malika mentioned. So what is the percentage of ownership that you're giving away to the investor? That is basically the dilution, because the percentage you're giving to the investor is actually what is being diluted from the other shareholders, right? It's very simple. Okay, so Shrikant is right. I'm not talking about me. It's the other Shrikant on the chat. So yeah, many of you got it right. So it's 20%, right? So let's just run this scenario, which just to validate this thought. And there are some other tweaks you can make, like option pool, etc. I'll not get into it. It just complicates the calculation a bit. There are also concepts like anti-dilution. If there are specific questions on this, we'll take it up. But let's just keep it very simple. You're taking 2 crore money at 8 crore pre-money. So your post-money valuation is 10 crore. And let me run this scenario. So suddenly you see the cap table that you saw here and the cap table you're seeing here is slightly different. Now, what is the difference? I've actually created a line item called unallocated investment. And I'm able to show you the cap table on an as if the investment has actually happened, right? So you suddenly see that this person has put in 2 crores and that person is given about 3 lakh worth shares, and overall this adds up to about 15 lakh shares overall, and 3 crore by 15 lakh makes up the 20%. Basically, on a fully diluted basis, 20% is given. Now what is happening to the other shareholders? If you recall, the other promoters actually had 33%, about 33.5 and 33.5% earlier. Now their shareholding has actually decreased to about 27% and 27%, right? Now this is exactly the dilution that Vikram was talking about, right? Now because I have taken money 2 crores at 10 crore pre-money, there is 20% value I am giving to that company. In the context, this automatically the shares are calculated as 3 lakhs, which make up the 20%. So 3 lakhs divided by 15 lakhs make up the 20%, and hence the remaining 12 lakhs, which was already in the cap table, in the previous cap table that you saw, will account for the remaining 80%. So all the other shareholders will get diluted to the extent of that remaining 20%, which you are allocating it to the new investor, right? So this is the larger logic for dilution. Okay. Now you may ask that let us change the scenario, right? Now, do you think 20% is a high dilution or a low dilution? Anyone has any thoughts on this? Again, it's fine if you don't have any thoughts as well. But like Vikram mentioned, many a times you might do too much fundraising that you will give away most of your company, right? Now, if you give most of your company, what is the word that Vikram used? That you will have less skin in the game. That means you yourself are not owning the company enough to give comfort to an investor that you will work in the interest of the company, right? The investor might just say, hey, this person is anyways owning less than 50%. He might run away tomorrow. He or she might run away tomorrow, right? So, so these are all the, calculations that you would need to do. Does that mean that people don't dilute at all? Definitely not. If you look at some of the unicorns, or let's say even a Flipkart or any big company, the promoters might be owning single digit equity by the end of, the series E, series F, or going closer to the IPO, and that is to the extent they will dilute. Does but that itself is worth so much. Flipkart is valued at 16 billion, so even a 1% stake in that company is worth 10,000 crores, right? So so that is the scale at which the value creation or wealth creation is possible. But there is definitely a particular trajectory at which things have to get diluted for the founders, and that is why I took this example. Now let us take a similar example. In fact, I have run the scenario. So uh, as soon as I run the scenario, it gets saved here. So you can actually go back to the same scenario and you will see the same 20% thing. So that is the beauty of the platform, that you can run these hypothetical scenarios and keep coming back to it. You can share it with your advisor, you can share it with other co-founders, investors, etc., and take advice on it. I had already run a scenario before this demo. I had run a similar scenario, like say instead of 2 crores. So suddenly you might say, 20% is too much. Why should I dilute 20% of my company in my first round itself? It's a very fair assumption. You might now have an idea. Let's say that, okay, 2 crore I needed for 2 years, basically. That if I needed to spend capital and grow in the business plan that I have created, I needed 2 crores for 2 years. But let's assume that I will make do with 1 crore. So let's assume this investor is still valuing at 10 crores, but now you are, instead of raising 2 crores, you're raising 1 crore, right? Now what is the disadvantage of this scenario? Like Vikram mentioned, your runway is coming down, right? Instead of a 2-year runway, now suddenly your runway is becoming 1 year. That if you don't raise money, or if you don't start generating profits after 12 months, and you start burning money, you might go bankrupt, or you might have to raise more money, right? Either way you have to either become profitable, or you have to dilute more anyway, right? But a lot of thought process founders put in that, hey, instead of raising all the 2 crores this year, if I actually raise 1 crore this year, I will dilute less. And maybe next year, when the new investor would come on the cap table, they might value my company much higher, and hence I will net I will dilute much lesser. In fact, or I say that for a 20% dilution, I can get a much larger runway, and maybe I will be able to raise 3 crore, 5 crore also, instead of doing all that upfront. The key thing here is the timing, right? The question is whether you want the money now, or whether you want the money 1 year later. And perhaps there's a lot of uncertainty as well. Many a times today in the pandemic, a lot of advisors are giving the advice, if there's money on the table, take it, right? Because there's a larger question of runway and uncertainty and all of that. There are those advisors who give that advice. Some of them who believe their business models might work, and who want to keep that optionality with them, they say, okay, let me just raise to an extent I need it, and let me not raise further, over raise it, so that I'll have to dilute more. So in this case, where I am using a 1 crore scenario, I'm using the same thing. Instead of 20%, now I'm diluting only 10%, right? So if you see, instead of close to about 6 to 7% dilution per promoter, now I'm only diluting about 3.3%, and remaining also proportionally lesser. So overall, now instead of 15 lakhs, there are about about 13.3 lakhs shares that are new shares that are issued, about 1.33 lakhs, and that amounts to about 10% of the shareholding, right? So these are two cases where, because of the quantum of the investment that is changing, my dilution is actually changing, right? And there's nothing right or wrong here. Like you said, now let's actually take an example where they raised a this case. This is a seed round. Let me do one thing. Let me actually assume that you go ahead with this investment, okay? That you have actually diluting 10%. So let me actually so you see, if I go back to the cap table, you'll actually see that the investor has not yet come, because what I ran was a scenario. It was a future hypothetical scenario. So let me actually put in a transaction. Now this is the way you manage a transaction on the platform. So let me actually assume that you have done the transaction now. So let's say you do the seed round. So let's say you bring in the seed investors. I've just created a dummy shareholder called seed investor, and you're giving the seed shares basically. and you can put some certificate ID. It's just for record keeping. And let's assume you're issuing it today, and then let's assume the number of shares from that calculation was about 1.33 lakhs. So let me just copy paste that. And I have actually done this math about at 75 rupees, it's about 1 crore worth investment. That's what you are basically interested in. And yeah, that's it. And another important thing this platform allows you to do is you can actually choose all the documents in one place. So once you raise investment and issue shares, you have to update the board resolutions, the share certificates you're issuing to the investor, the relevant ROC filings. So all those documents you can attach at one place, and you can keep it all ready. Right now, what this does is, when I say save, it is automatically now updating your cap table. So let me actually go to the cap table, and suddenly you see that the seed investor has come, and he has been given seed class of shares, and 10% equity is now transformed. Now let's assume, so we were debating whether you take 1 crore today, or 1 crore 2 crores today, or 1 crore today. But let's now assume that after 1 year this startup is able to raise the next round of investment. So now let us do a series A waterfall. I think I don't have it, so let me perform a new analysis on the waterfall. And let's assume now you raise the remaining 1 crore. Okay, so the scenario is now, let's say it's a pre-series A scenario, right? Because your series A should be much higher. So let's assume it's a pre-series A, another 1 crore. So this is the scenario we're running. Instead of raising 2 crore on the first year itself, we are splitting the 1 crore, 1 crore, and see how the dilution is actually changing, right? So now let's assume it is a pre-series A round, right? And now let's go to the valuation, because 1 year of traction has come, the company is making revenues and all. So let's assume the company is now at a 19 crore pre-money valuation. So instead of 9 crore earlier, or 8 crore earlier, it is at a 19 crore pre-money, right? So I think this is about 19 crore. And let's assume that you're now raising another you know uh, 1 crore on top of it, right? So now all things equal, you should ideally see 5%. So instead of overall 20% dilution, now you see that between the seed investor and unallocated new investor, it's only 14.5 dilution, right? So this is the advantage of staggering your investment, right? Where do you think the second case we did was a right and the first case was wrong? Not necessarily. Again, it goes back to the circumstances and the luxury you want to have on the books, that you want to sit on cash or not, and also what your other competitors are doing, right? Because if others are raising a lot of money and expanding or becoming quicker in their go to market, you can't be the laggard and say that I will just wait it out. You also might have to compete with them, right? So the only reason to kind of go through this in an elaborate way was to explain to you that it's your choice. At the end of the day, you can actually choose to stagger your investment and take only what you need, kind of a thing, or you can take a lot of money upfront, accelerate your go to market, acquire a lot of market share, etc., and become more and more valuable. In the first case, it might be possible that the founders might start diluting too much, and by the end of it, they might have a single digit stake in a large company. And maybe in the second company, you might still own like 30-40% of the company, let's say at a series C, series D change. Which one is right, which one is wrong, I will leave up to your judgment, right? But that is the kind of concept. This is the whole concept of dilution, right? So yeah, in this example, I tried to do that, play out those various scenarios, and you can do it for your company as well on this platform. And you can kind of download all the other features with regard to your shareholding or cap table is there on the platform. So I'll take a pause here. If there are any questions on the scenarios, if you want me to run something else, happy to do that. And if there are no questions, then we can then proceed very quickly on ESOPs as well. Uh, but I hope no, this made sense to all of you. Any questions? We'll pause for maybe 10 seconds.
Sure. In any case, I think even after the ESOP sort of session, we will probably be around for some more time. we can take questions that come.
Yes.
And like I said, please feel free to reach out to either of us outside of this. We'll be very happy to sort of help out and give at least share our thoughts and perspectives.
Sure. I think maybe
Sure.
you can proceed.
Yeah, I can. Let me just do that. Yeah, is my screen visible? Perfect. Yeah. Sure. So I think that's a great illustration by Shrikant on some of the theoretical concepts which we are sort of discussing. Coming to the whole concept of ESOPs, we felt that that is again a relevant sort of an issue which founders should think about at an early stage and at later stages as well. Because if you are out to create a world-class company, it won't be a one-man show or a one-man game, or let's say even 2 people or 3 people, etc. You will need to build a team around you, and how you motivate the team is what sort of dovetails into what we are covering here in terms of ESOPs. So again, starting from a zero base here for early stage sort of founders who probably haven't been exposed to this concept. So what is an ESOP? Right? An ESOP is an incentive plan created for the employees of a company to link their financial upside with the performance of the company and the increase in the valuation of the company. That's at a very, very sort of broad level what an ESOP sort of entails. So from a let's say contractual perspective or from a legal perspective, it is an option but not an obligation given to the employee to purchase a company's shares. So it's like a little bit like a call option on the company's shares. It is given to employees at a defined price. You define a certain strike price for the ESOPs. So you will basically tell your employees that I'm giving you ESOPs, let's say 1,000 shares at a certain strike price, at let's say 50 rupees a share, right? So the thinking here is that the company's valuation goes beyond 50, and the employee sees some value in paying up 50 and acquiring a share potentially which could be worth 100 or 150 or even 1,000, right? How do ESOPs work? Do you get the right to acquire these shares and exercise this option on day one? Not really. It is given over a period of time. That period is what is called as the vesting period. So the standard thing in India is for you to give like a 12-month sort of a period. So you grant ESOPs today, the employee has to wait for 12 months, and after the end of 12 months in installments he can start let's say I use the term vesting these options, basically converting these ESOPs into shares. He will have the right to do it, right? So that's pretty much called the vesting period. And what is the value which accrues to the employee? Like I said, the company is going to be worth different amounts at different points of time, and in the best of scenarios, it will be, as time goes by, the company's shares become more and more valuable. So the value which goes to the employee is effectively whatever is the price per share, the fair market value of the company's shares at a future date, minus whatever he has to pay the company as a strike price. So in this case, like I said, 50 rupees per share, you're pricing the ESOPs at this number, and you're telling the employees that you have to work along with me as a founder, and we need to make this company more and more valuable. So if I make the company worth 100 rupees a share in 1 year, then you guys have a gain of 50 rupees a share. If we make it in 3 years worth 500 rupees a share, then you guys are all making 450 rupees a share, right? So effectively, to sort of link the fortunes of the company with the fortunes of the employee is what you're trying to do with ESOPs. Again, it's a very, very important tool for founders. You will typically see all your top companies, top startups have a reasonable sort of ESOP pool. The importance is actually underscored if I just look at the top 50 unlisted startups in India, the unicorns, effectively. So close to 50 unicorns in India, more which have been created this month. Our estimate of value of those unicorns is $150 billion. And we assume that 10% of these companies will be held in the ESOP pool held by employees, which represents a massive $15 billion value which has been given over to these employees. So unlike other sectors, it's not that these employees invested capital to realize $15 billion of value. It's mostly their sweat and their efforts which have gone in, which have made this company big, and which has resulted in disproportionate wealth being created for employees. So that's why ESOPs are a very, very sort of important thing from an employee perspective as well as from an employee's perspective. Why go down this path of granting ESOPs? Like I said, align your employee incentives with the valuation, the value creation in the company itself, so that as a founder and as investors as well, all of you set to benefit. Let's say if instead of giving ESOPs, if I'm going to give it out to employees in the form of cash, is there any motivation for the employees to actually track the company and to ensure that his actions go into creating value for the company? May not be as much, right? I'm not going to say no, but it may not be as involved as it would be if you had actually given them ESOPs. To drive entrepreneurial behavior with your key employees. So as you want to create a world-class startup, your key employees should behave like founders, should behave like owners of the company. And the way to do it is actually make them owners of the company by giving them ESOPs, right? The third element is to allow employees to participate in upside. Like I said, right, $15 billion. The founder making a lot of money in these unicorns is one thing, right? And at the end of the day, founder took the risk. He brought the capital in, he got the investors in, and he sort of built the company. But for employees, let's say in senior and even in mid-level management, to make the $15 billion sort of a gain over maybe in the last 10 years or so is like phenomenal value creation, right? So we see this to be like a cycle that employees work in these startups, they get a lot of exposure, learning, they get upside as they sort of are given ESOPs. They are motivated to work very, very hard to ensure that the company scales. And once the company has an exit, the next class of entrepreneurs and founders are created, and they will actually have the risk ability and the capital to start the next business. Right? So this we sort of see to be a virtuous cycle within the Indian startup ecosystem itself. ESOPs are a great way for early stage startups to conserve cash. So if you're an early stage startup, you're bootstrapped, or if you've raised angel funding or even seed stage funding, pretty much I would say until you get to like a very, very sort of advanced stage of funding, you're going to be fighting for talent with larger companies. What can you offer a person that he will quit a Microsoft or a Google and he will work for you when you're, let's say, running an early stage tech startup, right? ESOPs play a very sort of valuable sort of role here. So you cannot match a Microsoft or a Google salary, but by giving ESOPs and based on the quantum of ESOPs you give to an employee, you can actually convince him to say that your upside is higher when you work for me, because you're not going to see a major upside in a Microsoft or a Google. They are large companies and you are a very, very small part of those companies. But I value your contribution, and I'm willing to sort of recognize it by giving you stake in my company. And therefore, even though you may even take a pay cut, but I think you should join me, because over a 2-year or a 3-year period, we can make something big, and you will get a non-linear upside, right? That's the pitch which you make to an employee, right? So it helps early stage startups actually conserve cash while attracting the best of talent available in the market, right? And ESOP is also a tool for employee retention. So like I said, it's not something which you give an employee on day one. It takes a 12-month sort of period for the vesting to start. And then even the vesting doesn't happen in one shot. It happens over a period of 2 years or 3 years after that. So it's also a motivation for the employee to look at this opportunity to work in your startup as a long-term opportunity, not something where he comes, works for a year, makes some money and leaves. Where he can really realize a high upside if he sticks on with the company for 2 years, 3 years, 4 years and beyond, right? So these are a few things as to why ESOPs are very critical from a company perspective, from an employee perspective. Now, whether or not you agree with these points, what also tends to happen as you go in for external equity funding, even at an angel stage, you will actually see your investor insisting that you create an ESOP pool in the company. Because like I said, the prevailing thing from most investors is that you cannot create a world-class company if you don't allow your employees to become owners in the company. And if that process is going to happen, and you're going to create an ESOP pool after an investor is invested, that will dilute the investor. So most investors say that, I want you to create ESOPs, and I want you to create ESOPs before I invest in the company, because I don't want to be diluted. So you should dilute as a founder. You should set aside some of your stake for the employees and future employees as well as for current employees in your company. and then I will invest, and hopefully we make it big, right? So that's why ESOPs, you will see most startups have create an ESOP pool. I'll just briefly cover the life cycle, won't go too deep into the aspects here, but just to give a flavor of how this entire process sort of happens, right? So typically, like I said, when you raise a round of funding, you will actually see a clause in your shareholder agreement, which will say that, okay, prior to my entry, I'm going to invest, let's say, whatever, $1 million for a 20% stake. Prior to my entry, you should create an ESOP pool of at least 10%. Right? So your obligation to create a pool typically gets linked with your first round of funding. After you have completed your round of funding, you will have to draft what is called an ESOP plan, which is like a legal document which sets out the sort of rules for implementing your ESOP scheme and how your ESOP scheme is going to be administered. So it's a legal document. It has a lot of clauses. You will have to get an advisor or a law firm to draft this document, put it in front of your board of directors, which will include the investor now, and get their approval. And you will also need to set the exercise price for the ESOPs, right? So in an early stage, most companies will say that I want the employees to get a good gain out of this. So my company may be worth 100 rupees a share, but my face value is 10 rupees a share, and I want to give my employees exercise price to be the face value. So that when I'm giving them the shares, I want them to see a profit of 90 rupees on day one. But over a period of time, it gets more and more valuable, right? So that is something which it's up to companies. In early stages, you will keep it as low as possible, but as you become more and more mature, companies start resetting the exercise price. So basically, they tell an employee who has joined after 3 years that the guy who joined me in year one, he took a big risk. So I'm giving him an attractive price of 10 rupees a share. You have joined me in year 3 when my proof of concept, my product market fit, all of it has been established when I'm showing scale after my Series A round of funding. So I can't allow you to, sort of take ESOPs at 10 rupees. The price is now reset to 100 rupees. It's still a discount to the last round of funding. The last round of funding would have happened 300 rupees. So you're still making a good amount, but you're not going to make as much as a guy who joined me early. So you will reset your excise price at a certain point of time, but for early stage startups, typically keep it as low as possible. Right? So as employees join, you will give them what is called a grant. So this will take the form of a physical letter, or if you're using a platform like ours, it will be like an e-grant, which is delivered through the platform. Basically, a letter to the employee to say that, okay, you are joining me, you are entitled to X amount of ESOPs at X, sort of strike price, which will vest over a period of time. So typically you'll do this as the employee is sort of joining. After you do that, then you will sort of track vesting. So like like I said, you'll have a vesting schedule to say that for the first 12 months you don't get to exercise. At the end of the 12 months, maybe 25% of your ESOPs become vested, where you can actually ask for that to be converted into shares. And then for every year beyond that, another 25% will sort of vest. So effectively, what you need to do as a company once you give these ESOPs is you need to keep tracking these vesting. So typically, this becomes a bit of a process. Once you cross 15 employees, most companies maintain this on Excel, and it becomes a bit of a manual process to keep tracking of to keep track of all this vesting schedule for each of your employees, right? So your vesting can be time based, it can even be performance based. You can go to some employees, give them a grant, and tell them that apart from time, you are heading this business unit. I want you to deliver X amount of revenues in this business unit. Then you're eligible for certain ESOPs, right? You try to link it with, you may want to link it with your performance as well, right? And most companies, for administrative convenience, may choose to have your vesting period on an annual basis to say, okay, 12 months you don't vest. At the end of 12 months, you vest a certain amount, and every year after that, you vest a certain quantum. But that's done more for administrative convenience. What we are actually telling startups, who are on our platform is that given that our platform is handling your vesting and calculation of all of that, you can even go in for an aggressive vesting. You can even think of monthly vesting. So then employee feels for every month he's working that, he's getting some ESOPs vesting happening on a month-on-month basis. So motivates employee a little bit. So once the option is vested, the employee has the right to ask for that option to be converted into shares. So you can sort of allow for exercise to happen, in which case the employee actually becomes a shareholder in your company. So we will track him as an ESOP holder till the point of time he has the ESOPs. But when he exercises and actually gets allotted shares, he goes into the cap table itself, he becomes a shareholder. But the Indian tax laws are fairly restricted. So the employee may get hit with a sizable tax liability when exercise happens, where he may convert the ESOP into share, but not that he's got cash. So what a lot of companies also started doing is to say that I don't want you to go out of pocket and pay tax even when you don't have, you'll have to pay tax out of your salary. You may not actually be able to sell these shares because we are still a private company. So many companies actually go out and say that we will allow you to exercise only when a liquidity event happens. Either I'm going for IPO, or I'm selling the company, or an investor is coming in and he's giving some liquidity to the ESOP holder. At that point of time, I'll allow you to exercise, so that you will be able to sell immediately after that, and you can use the sale proceeds to pay tax. Right. So that's post exercise, the sale is what is the next step. That is when throughout the cycle the employee will actually realize cash. So this is a full cycle of ESOPs. So again, I'll pause here, turn it over to Shrikant, and he can actually show you as to how our platform can help you in managing your ESOP sort of plan as well.
Yeah, okay. There was some question I was just trying to answer. So yeah, I mean, to answer Mohan's question, right? So like I mentioned, there's no standard rule as such. There are some rules of thumb with regard to how you both qualify people. So one is you only need to qualify people who have that long-term vision along with the founders themselves, right? If they relate to that, being participating in the long-term vision of the company, you basically give ESOPs to them. You don't want to give ESOPs to, very, let's say, an opportunistic employee who, tomorrow gets a better offer, kind of can jump in. There's no vision alignment. It's more a very monetary aspect. Now within that there are various buckets. So at a very senior level, co-founder level, the question is more on, let's say, what's the actual percentage in the whole ownership you're talking about. But when you talk about middle level hires or technologists, etc., it might be, a quantum of their cash compensation. Is it whether, a multiple of it, or whether it's a fraction of it, and we have seen all ranges. People getting as low as 10% of this, cash component, to even getting, let's say, 2x 3x of their cash component as well, as a reward. Or also the difference between, what Vikram also mentioned, what they are foregoing basically with what they used to get in the market, with what. So all these are basically metrics you can use. So to answer your qualification point, you only give ESOPs to people who align with the long term, who want to stay for 4 or 5 years. And for regard the quantity, you can quantify based on these kind of metrics, the difference between the market, what that person is getting market, their long term prospects in the company, and the value that person adds. And based on the seniority, the conversation is basically a percentage of the basically the cash component. Hope that answers. And I'll just to summarize, because there's not a lot of I mean, I don't want to again demo a lot of technicalities here, but maybe very briefly we'll take a startup example and walk you through the basic ESOP related aspects. So I'm assuming you can see my screen. So this is a new company. Basically, it's a Singapore-based company for a change. And so you see that, there's ESOPs shown separately in the cap table. So you can manage all aspects of ESOPs on this platform that we have built. So if anyone wants to set up their ESOP plans in the future, you can reach out to us and we can help you set it up. So if you go to equity awards, this is where your all your long-term incentives or equity-based incentives are managed. Okay, so so you get a quick dashboard as an administrator. Basically, you are the founder or you are the head of HR with that administrator access. So here you can manage all your plans. A startup can have multiple plans. This startup has 6 plans because this is just used for demo purposes. But a typical startup might have 1 or 2 plans based on the maturity of the company. If you don't have a company, then if you don't have an ESOP plan, then you can actually create a award plan as well in the platform itself. So you can punch in all the details, all the aspects that Vikram touched upon. I will not go much into it, but the vesting schedule, the separation details, what happens if an employee leaves the company, because they the employee should not be getting shares that have not been vested, right? So there should be placeholders, because you're tying in the long term alignment of the employee with the vision of the company. So you want to keep the separation details as per that, etc. So you can create your plan here. You can manage your plan, like I said, and you can also grant your plan to your employees here itself. So let's say you want to grant to a particular employee, you can select a particular employee. Let me just do that, and then automatically you can say that person is an employee, and you can select a plan which will automatically pick up the vesting schedule. I'll just show you that. Let's assume there's a strike price, like Vikram mentioned. It can be as low as 10 to begin with, and you are giving some awards, let's say
Yeah,
1,000
she
shares.
can grant date also. Just fill in the grant date.
Yeah, so let me actually fill the grant date. So based on this and the vesting schedule, automatically from the plan the vesting is created. So this, you see that there's a 4-year vesting after the. So if I'm giving shares today, which is April 19 2021, and I'm giving 1,000 shares overall as grants, as options today, they are getting vested. As you see, after 1 year only 250 is getting vested, which is 25% of 1,000. And then every year 25, 25, 25, like 4 tranches are given out, right? Is this the only way you have to vest? Not necessarily, right? You can actually start vest quarterly also, you can vest monthly also, all that you can do. So basically, if I change the vesting details to monthly, and then instead of the 4, put that 36 months. So you can actually see the first year the 25% is getting vested, but the remaining 36 months, 20% is getting vested till the remaining 3 years, right? So uh, so this is all up to your strategy. We recommend that for growth stage startups, where employees are contributing month on month, just like they're getting monthly pay slips, perhaps they can also get equity rewards on a monthly basis. We believe a lot of startups never used to do it because of the hassle of actually doing it manually, maintaining it on Excel, etc. But with this platform you can actually do it automated. And the moment like April May 19 2022, automatically email is sent to the employee with saying 20 shares are being rewarded to you as part of your ESOP grant, right? So yeah, you can play around with the vesting schedule, all of that you can do. And then you can also select the various nuances of what happens if the employee leaves the company, whether it's a voluntary termination, involuntary termination, various use cases like death, disability, etc. What happens to their vested shares, unvested shares, all of them, so that the employee also, when they receive this grant letter, and I'll show you the summary. You can also enable acceptance flow, add a bunch of documents, and so here you will actually see the overall summary. So this is what the employee will actually see, that how much that employee has been awarded, what's the date, what's the exercise price, and then the vesting schedule. So here that person will see the entire vesting schedule. So it's very transparent, and you can also transparently show all the separation details. What happens to the unvested shares on various cases, what happens to the vested shares, right? And this transparency helps them to kind of uh, plan their move, take decisions, etc., and choose to exercise shares and all of that. So, and yeah, this is so everything I'm doing is on the system. So grant is awarded successfully, the employee will start seeing on their platform, they can accept the grant, and it will start seeing on it permanently. Once the vesting happens, automatically the communication is sent out, and once they exercise, then they become shareholders, right? So this entire workflow of equity ESOP management is now managed on a single platform like this. And let's assume that I log in as an employee now. So let me just do that for very briefly for a minute. So if I log in as an employee, I will see, so just like you see your pay slip and your monthly, how much cash you're making, this is like your personal equity dashboard, right? So as an employee, like I'm the Shane Coates here, so I can see that I have overall 37,000 grants, like which are shares, equivalent of shares. And then out of that 37,000, 29,000 is unvested, which means I need to still spend my time in the company, or like hit my performance milestones. And 6,666 is already earned. So vested is earned shares. So I have already earned this share. So even if I leave the company today, I will get this much worth shares, right? And overall, this pie chart indicates the vested and unvested split up. Overall, I can also, if I know the valuation of the company, I can also see my ESOPs are worth so much, right? So it also gives a very tangible value to that ESOPs. Otherwise, ESOPs, are just there and you might not attribute any value to it. So with this platform, you can actually attribute, get to know the value of your ESOPs. And and you can also, over a period of time, we are building a feature where you can actually see over a period of time how the value is accruing as you are vesting more and more shares, as well as you are the value of the company itself is growing, right? So suddenly the wealth creation that you're able to create with these ESOPs is quite high as the company grows to become, much valued and eventually becoming a unicorn. Let's say that is what is happening these days as multiple unicorns are coming, right? So this is all, a very nice platform for you to manage all aspects of your ownership. So we discussed, cap table earlier. Of course, this is a different view. And by the way, the shares I awarded to this employee is sitting here, so I can actually accept the award here on the platform itself, and it'll get added to my uh, account. And this is the way it will automatically. Let me just summarize the session, and we can then open up for any last questions. So as we discussed, so this is one platform where you can manage all aspects of your ownership, your cap table. We talked about the cap table, all your shareholders in one place, the necessary documentation in one place, right? Your shareholder agreement, your board resolutions, share certificate, all of them are stored in one place, right? And then you can also manage your equity awards or ESOPs in one place, like we just discussed. And you can run some scenarios, see how the dilution works, how waterfall works. I didn't cover that, but happy to discuss that at a later stage. But basically, if there's an exit event happening on your event, somebody is acquiring your company, what does it mean for all the shareholders? And manage all your transactions at one place, like we discussed, right? Uh, so it's to summarize, equity is a very, like I said, it's both a very sacred as well as a most valuable aspect of your company. And if you're looking to raise money, dilute equity, etc., you need to plan in advance, keep things in ready, and stick to your plan. And if you execute your plan, you'll unlock larger value, not just for yourself but also the partners who joined you in your journey, as investors, as employees, etc. And investment and equity awards, ESOPs are all instruments through which you share that value, for bringing those partners on board, because only together you will build something much more valuable than you could have built on your own. And that is the whole essence of sharing equity, which kind of was a central theme which we discussed today in the whole webinar, right? So with that, let's take a pause, and if there are more questions, we can take that up. If there are I'll also maybe quickly share one last slide, which is basically the way you can get advantage from our platform, etc. So for this audience, we are happy to give our platform up to 25 stakeholders. We can give the product for free, or if you have raised less than 1 million US dollars. Beyond this also, it's very affordable, and we'll also help the startups in their investment readiness, ESOP creation, etc. And you can also access a community we have created for raising investments, basically, right? So with this, bring the webinar to an end, and open up for more questions, and this is the way you can reach us. Thanks, everyone, and over to you, Anudeep.
Yeah, thank you, Srikanth, and thank you, Vikram. Definitely, it was informative, and coming from an entrepreneurial background, I definitely understand what's the kind of ease that your platform has created. Because I've seen entrepreneurs, and from my experience, that we talk a lot about ESOP pool or using the sweat equity, but because of the only literature available being in statutory language, it becomes difficult for an entrepreneur or the startup to manage this. And you definitely made it easy. And thanks for for providing that promotional scheme for the startups here, because I definitely would encourage the startups to try it out, try the scenarios, because uh, weighing out between the runway and the dilution is definitely required. And they can try it out on the platform. So I definitely encourage the startups to reach out and use the platform and play around, so that they can from the start plan in terms of the kind of equity that they can set aside for their core team and the employees. So thank you for those enlightening, and in fact, you made it easy with the example, and taking us through the platform, so that they understand it step by step on what all aspects should be impacted. So we'll open for Q and A. The attendees can post their questions on the chat, or use the raise hand option to come on stage and talk to the speakers. So, and they're around, so you can also talk to them and interact and they can also guide you in on a case by case basis in terms of your specific problems if you have any. So in fact, we've had an audience of close to 60 today across both the
Great.
platforms of AirMeet and YouTube.
Yeah. So great. I saw that there were questions on both the platforms, and happy to, I mean, have addressed them. But any other follow-up questions, we can take it offline as well. You can
So
reach out
maybe
to us.
Srikanth, can you just paste the coordinates in the chat so that I can.
Yes, let me do that. So this is my email, and I'll also paste Vikram's. And we also there on all the social media, so you can connect with us on LinkedIn and
Yes, yes, I will do.
Twitter as well. Should we wait for us some time if there are any questions?
Yeah, sure.
Yeah. So anyone, if I think you can, if you someone wants to speak, maybe you can also unmute or you can use the chat, and
Yeah,
we
so
can.
that's what. So they can use the raise hand option so that I can give them the mic and they can.
Okay, perfect. So any questions? If anyone you think you need assistance in setting your cap table, talking about dilution, running different scenarios for your own fundraising journey, we'll be happy to do it. I also mentioned that we run a small community where if you are looking to raise funds, we'll be happy to make introductions to you to various angel platforms, incubators, accelerators, etc., which might be of relevance to you. And again, with ESOPs also, many of them, and some of the questions like what Mathura asked was very relevant. Sometimes founders don't have the experience might not have enough background or benchmarks on what is the industry practice. Like I said, there's no one rule for it, but it helps to understand what the other counterparts are doing, so that you can kind of have the benchmark. So like how much should be the option pool, how much ESOP should you give to a co-founder who's coming in later? How much should you give for an early stage strategic member, or how much should you give for a developer? Who is also very valuable, as in these times. So these are all, there are some benchmarks we can definitely share with each of you if you have any questions around that.
Maybe we can end the session and in the lounge area, they'll be available at the table. So in the lounge area too,
Yes,
you can connect and talk to them directly.
sure, we can do that.
So that would help.
Great.
Thank you, Srikanth, and thank you,
Thanks a lot,
Vikram, for
Anadi.
joining us. Thank
Thank you, everyone. We enjoyed as well, and enjoyed the interaction. Thanks a lot, Anudeep and Tai AP, for this opportunity, and we hope to do more relevant sessions based on the topics that you might
you. Yeah,
see.
just a second, Srikanth. There is someone who.
Okay.
Yeah, Gopi, you're on air. You can talk.
Hi, Gopi.
Hi, Gopi.
Yes, Gopi, go ahead.
Uh,
Okay, he dropped out. Anyway, we can interact in the lounge area. So, Srikanth and Vikram would be available at a table, and you can join them and talk to them in person.
yes, sure. And I also shared our coordinates, so we can also connect with us on these platforms. So thank you all, and we'll see you at the lounge. Whoever has any questions.
Thank you.
Thanks, Anudeep. Bye.